I'm going to start with some of the questions that are in the platform, and welcome back, everyone. I forgot almost about welcoming you back. You're here to support, and I really need you to answer all these questions. Let's get straight into it. First question, someone would like to know, can you give us more color on how 350 million EBITDA uplift from growth is split by 1, leverage from volume growth, and 2, net price versus raw material impact?
Yeah, Maria, thank you for the question. I think since we always handle the bridges to Maarten, maybe Maarten, you want to give a comment on that?
Yeah, thank you. So indeed, if we look at the 350 million EBITDA uplift from growth, it contains 3 elements. First of all, it contains the element, indeed, the growth and the drop down based on the growth, and we use normally an approximate of roughly 40% gross margin. Secondly, it is the pricing versus raw material and how that will evolve over the coming quarters. And thirdly, it is also the investments we are making in growth. And that contains advertising and promotion, but also investments we do in the sales force and in, for instance, digital solutions. And in fact, Michael was alluding to that earlier. So these 3 elements, the drop down from growth, margins, expansion, price versus raws, as well as the investments, are part of the 350 million.
Thank you very much, Maarten. Another question, for the market value CAGR assumption of 6%, what is the assumed pricing CAGR? And is it more than half, or is your 2% haircut on price or on volume?
Yeah, it's probably not very, it would go long in what all the assumptions are, but basically when we did the analysis through the businesses, by the way, bottom up, we came to a growth rate that was slightly higher, and in fact more in line with the ORM Boss one. We then basically took a haircut, and in fact it's less pricing and it's margin. I think Maarten already alluded to that. What we said is, okay, and we've been talking about this before, we do believe there is a high amount of stickiness in about 60% of our portfolio on the current pricing. So we actually did an analysis on where we were going to go. And secondly, on volume, it was pretty aligned. But given the remarkable situations in the economy, we actually took a haircut on the volume because of inflation. Is there, I would say, a recession case is probably too big a word, but a more negative case on that. So it was on both sides that we actually took a step back, and that miraculously was in fact our own roll-up was very much aligned with what external consultants came up with, and that's why we took the haircut on both sides. So it's margin and volume.
Right. Another question, someone says, Matthew Yates, Bank of America, the plan looks like it's based on the ORM Boss study. First question, did Akzo pay for the survey? And secondly, what is their track record in successfully forecasting the market growth?
It's a good question. No, we did not pay for the
ORM Boss survey. You did not pay for this.
If you really want to go to the genesis of it, as I indicated, the businesses, of course, came up with their 2-year plan, and that gets scrubbed by all of us. I mean, on where do the numbers come from? Mm-hmm. It's also because we come out of a very special situation where some businesses really, we talked about marine protective, we talked about the aerospace, so we saw the dynamics in it. ORM Boss is probably one in our industry for paints and coatings, the most reputed company who comes with it. They typically are pretty much on the money when it comes on their forecasts. So our own roll-up, when the ORM Boss view came out, and we looked at the segments where we're in. So for example, we excluded Deco North America, we excluded car OEM because we're not playing in that. In fact, those numbers were very much matching up to our own numbers, and then we actually reduced it down. That record, and I've already implied to that, is actually pretty accurate for our industry.
Right. Just one more question from the same person to follow up. Put another way, is it fair to say coatings has historically been a GDP minus industry in volumes, and you now think GDP plus? And why is that? Is it because innovation, execution?
Yeah, well, let me hand this over also to Michael, but don't forget where we come from in the last 2 years. I mean, I just want to point out that some of these segments like aerospace is the natural grower. That wasn't happening given everything that happened with travel. So that is going to be an overcompensation. Marine and protective we talked about has been, now we see basically it coming. So you have to see it in the dynamic of where we come from. But Michael, maybe you want to give more comment on that.
Yeah, and again, the numbers we've shared are not volume numbers, but top line. So that's the first statement I would like to make on this one. And what you also have to know is that we really don't steer that much by volume, because a lot of what we do is increasing the efficiency of the great solutions we offer to our markets. And that oftentimes means 20% less volume if you have a coating that is just working better with a thinner layer. So from that angle, volumes really do not play such a big role in our own internal plan, quite the opposite, especially when it comes to sustainability. A lot of our customers are also interested in achieving the same fine finish, the same protection with a slightly thinner layer.
Thank you very much, Michael. I'm going to turn to the Zoom environment because I do see we have a guest there. Hi, hello. Could you please state your name and tell us where you're from?
Brilliant. Yes, you've got Charlie Webb here from Morgan Stanley. So maybe my question would first be on the cost savings, the 200 million that you've announced today. Can you help us just understand the phasing of that? As in, when should we start to see that materialize in the P&L? And likewise, also, what is the associated cost, if there is any, to those savings? That's kind of the first question. And the second one, probably for Martin, around cash deployment. You put out an interesting wagon wheel showing the cash deployment of Akzo over the last few years. How do you see that on the next two? How is that going to evolve in the coming 2 years in terms of allocation to M&A, which perhaps was rather small in that wagon wheel? Do you expect that to increase and vice versa? Share buybacks obviously playing a large part. How do you think that will evolve in the coming 2 years from your perspective?
Let's start with you, Tim.
Yeah, let's start maybe with the first part on the phasing. It really depends on bucket to bucket, obviously. Let me maybe address the product management side, and then maybe Karen-Marie, you can talk about your part of the village where you're operating. Okay. I would say on the product management, both on the Deco EMEA and for the resin side, you'll see things coming in already in 2022, but it's fair to say that the vast majority will probably be in 2023 of that. And the reason for it being that Deco EMEA is rolling their product portfolio plans out right now. There is always a time to implement it, so I think it's going to be the latter part of 2022 when that starts rolling in, but then you pass the season. So I think you'll have the full amount of it in 2023. On resins, Michael, I don't know if you want to give a line which you think will come in?
No, we're working already on the implementation, so we expect to see first results trickle in already in 2022, and then progressing into 2023, where we aim to hit the 15 to 20 million EBITDA improvement.
Yeah, and Charlie, just to finish on that point, on the costing side, there is really not much costing involved. I think Michael has been indicating it's getting organized around it because it was a bit of the neglected part of our portfolio. So it's actually relatively limited, I would say. And the product management is actually just getting our act together, so there is no specific cost associated with that. I don't know, Karen-Marie, if you want to talk about the other part of the liver.
Yeah, I can do that, absolutely. As we talk about the continuous improvement, we are already executing. We already have programs in place that are delivering. We are having a good constant follow-up on those for 2022, and obviously also very much looking into what is it then we'll have in the plan for 2023. So very clear plans in place and being executed as we speak.
On the cost side, Martin, maybe you can do that before you get in the second question, then around what is our provisions that we were kind of the order of magnitude to think about.
Yeah, because I think it's important, first of all, to think about the 200 million. It's OPEX and margin, so don't see this as a pure OPEX number. But indeed, some of the initiatives which are driving, especially on the asset network optimization, that requires restructuring costs. And to give an indication, that would be for this year as well as next year, roughly between 75 and 100 million per year. But again, their timing is always of the essence in terms of what we execute by when. On your other question, on your cash deployment, we've always said that, and that's where the word modular share buybacks come from, that we look at our opportunities we have in M&A, and if not in M&A, then we basically have more opportunities from a share buyback perspective. So I would not say that what you've seen in 2020 and 21 is immediately the same for or similar for 22 and 23. Because again, it depends very much also on the deployment from an M&A perspective.
Yeah, if I may just add on that, Charlie, I think again M&A is for us less neurotic. We have to do this. It really goes back to the assets that are available and are they solving an issue in our portfolio. So it's very difficult to foresee. And frankly, if the valuation goes out of the window like we have in certain cases, then frankly there's other ways of solving and creating more value that we feel. The other element are on the share buybacks. I would say. Try to summarize it a bit in our closing comment, but if you look at the amount of shares we will have outstanding in 2023, by the time we have done this latest module that we've announced on share buybacks, if you look whether you're an optimist or a pessimist around this 2 billion, depending on how you buy into our story, and then you look at our multiple, frankly, it is probably the best use of our money right now. If you see what in fact the underlying value is and what the current valuation is. So that is a pretty steep hurdle for any M&A project to basically compete with it.
Thank you very much.
Very helpful.
That answers your questions, Charlie. Thank you so much for joining us. As another slide, another question that came in through the platform. On slide 17, where marine and protective are mentioned, they're so low on the attractiveness axis. And this person says, I understood it, that it was just a very attractive business. So why is this?
It is. No, it is. And I think if you allow me, Michael, to jump in ahead of the front lines there, the attentive spectator will have seen that there was an arrow on those two bubbles. It is indeed, and I think I pointed it out, that marine and protective with all grip with international is one of the strongest. In fact, it was one of the highest performing businesses in margin, but it is a very technical business that needs a lot of resources in the market. And in fact, the market was down significantly. So I think we've cost reduced as much as we can without doing damage on the business. So that's why I think you also alluded to that. That's why we have the arrow. It should come back to its former glory. Okay. And we see it moving in that direction.
Good to know.
I don't know, Michael, if
anything you wish to add?
I think just technically, I mean, the chart was a 2021 year-end position chart, and that explains where the bubbles were. And then again, as Thierry rightly pointed out, because we saw that coming, we put that little arrow in there to indicate that we see that to change quite quickly and quite significantly.
And positively.
Yeah. And positively. We could have done it the other way around, but then people would have said, okay, but why it hasn't been performing the last year, so okay. So, but that's the story behind it.
Clarified. Thank you very much. I'm moving back to the Zoom because I see we have our next guest. Would you please introduce yourself and tell us from which company you are?
Hi, this is Jaideep from OnField. The main question really I have is, Thierry, and Martin actually as well, on the as you said, you love doing bridges. So on the bridge itself, how should we really think about the cadence for 22 into 23? Because 23 is not really far away. So the 200 million that you're talking about, is it going to be sort of evenly split in 22 and 23? And the 350 is more so coming through as we see pricing catch up on raws and growth coming through, and therefore there's going to be a sharp hockey stick in 23? Or do you actually see growth in 22 and sort of taking a baby step in 22 towards the 2 billion and then a big step into 23 towards the 2 billion? So if you can just give us some, let's say cadence of that'd be very helpful.
No, thank you, Jaideep. It's on the, let me maybe handle the top line, or I'd say the margin point, and then maybe Martin, you can chime in on the cost side. Indeed, I think for the first quarter of this year, we don't expect necessarily too much. I think you'll see some markets coming back, but as we already said, they still have to get over the hurdle of the raw materials. We do expect that, in fact, to start widening up that margin expansion that we talked about as of somewhere the middle of this year. And then I would say it's probably, nothing is ever linear, but it would probably be a relatively linear situation. You have to take seasonality in place getting into 2023. So that would be in the next 3-4 months, I think you would start seeing that gradually opening up. So not a hockey stick, but a line that starts at that moment of time. On the costs, Martin?
Yeah, it's a good question, but let me take us back, because most of the initiatives we've been talking about, we have been already initiating these initiatives from 2020 onwards. So Thierry talked about product management. That initiative started in 2020 already. And some of the initiatives have been ramping up. So in general, you will see a pretty equal split between 2022 and 23. Some initiatives might be a little bit more into 23. But again, these initiatives have been part of our grow and deliver strategy and are not started up kind of yesterday or today.
Great, thank you.
Great. Thank you very much for asking your question. Moving on to the next, Alex Stewart says, in the 15 by 20 management compensation was linked to the targets. So management compensation linked to targets. Will this be the same for the 2 billion targets?
It actually is for the large group of the management in the company. It is. The exception is actually the board of management, Maarten and myself. We do it pro bono. No, I'm just kidding. But it's no. But that feeling was given the shareholdership that is a different way of remuneration. But it is fair that for a large group, like we did for 15 by 20, there is an incentive indeed linked to those targets.
There is an incentive. Our next guest, Chetan Udeshi, if I read correctly, says, I'm very surprised that a company as big as Akzo has a high level of single sourcing. Can you give us some examples of such raws?
Yeah, good question, Chetan, and it's a legitimate comment. But I think you would see that with many large companies, by the way, are probably the biggest sinners on single source product. But before you think that we are completely, in the past, were asleep at the steering wheel, that's not correct either. What it often is the only, either we have single sourced, and don't forget that you have the 80-20 rule. You have 80% of our volume sits with a number of big resins, TiO2s, etc. Yes, sure, there we have different options and multi-sourced. But then you have an enormous rat's tail of additives, specific pigments, etc., and that's in fact where the issue is. By the way, in 2021, for our whole industry, by the way, the not being able to supply because of raw material shortages was often due because there was wiffle dust XYZ was not available, and you had to reformulate the whole thing. To actually do it without that specific product. So it is, in numbers, it's actually not that surprising. So if you ask for what examples are, it sits in rheology modifiers, it's in special pigments, it sits in specific waterproofing elements, etc., that go in there. In specific cases, though, and that is important, and take TiO2, of course we have multiple titanium dioxide suppliers, but in many cases we had only qualified one specific TiO2 for one specific product. And in a technical market, when there is an issue with a TiO2, now you have to reformulate, and there's always slightly different things. So there we want to buy, or we want to really dial in much more flexibility, so we would have in that specific case 2 or 3 TiO2s or 2 or 3 rheology modifiers to solve an issue. By the way, 2021, to echo a bit what Maarten has been saying, has been an enormous jump start of doing that, because our R&D organization has been reformulating products all over. And the nice thing is that we did that product development, product management work, so they could be developing and modifying and reformulating in the direction of the best product portfolio for the future. So,
okay.
So I understand your surprise, but it is what it is.
It is what it is. Moving back to Zoom, I see we have our next guest. Hi there, could you please state your name and company?
Hi, it's Mubashir Chowdhury from Citi. Thank you for taking my questions. I just had a couple. Firstly, a clarification. I assume that Orbis deal makes up part of the 350 million of the growth side of things, so that 30 million sits within that. And could you just clarify which bucket within the 350 that you've talked about it sits within? And then the second question is around, I think in the marine and protective coatings, you were number 1 as of the previous slide deck in February 2020. And now that seems to have dropped to number 2 in terms of your market position. Could you please provide some color as to what's driving that, and is there any particular part of the market that you're losing share in?
Yep.
And if I could, sorry, just if I could just squeeze in a third. Can you please talk about the return on sales in trend, how that's trending in China? I know that's a big kind of a growth initiative for you, so I just interested to know how that's moving on in profitability. Thank you.
No, very good. Maarten, you want to address the first question?
Yeah, so your question on Orbis, in fact, the 2 billion adjusted EBITDA target is based on organic growth, and Orbit is not part of the 2 billion.
So it's excluded from that?
It's excluded.
Now, I'm not sure, Mubasher, if you're stunned or if the screen is frozen, but it is not part of that. So it isn't. So just as the answer. The second thing, it's a legitimate question on marine and protective. Michael, it's probably good to say how we have been keeping the discipline and what the effect is on that.
Yeah, so marine and protective is indeed, as you've heard me talk about earlier, is the one where we expect the highest growth now going forward. We had to do a couple of things in-house in order to address topics that were not going the right way. We think we have completed that, and now we're quite optimistic about the future of that business.
And then the last question was on the return on sales in China. Suffice it to say that it has been trending gradually upwards, but it continues to be the top quartile of our businesses by far, I would say, on profitability. And that has to do with the fact how the strength in the distribution, also the Dulux name in China is a real recognized brand name, but also the fact that the team has done a fantastic job to launch anti-asthma products, air quality products, bio resin-based products, etc., which are in extremely high demand in the Chinese market. So it is one of our highest return on sales businesses in the company, and actually has been trending upwards.
We hope
Understood. Thank you very much.
Thank you.
Thank you very much indeed. Moving to a next question that came in through the platform, again from Chitan. Can you give any examples of progress with Scope 3 reduction targets, and how is the progress with your upstream suppliers in terms of their emissions reduction?
Yep. Klaus, you want to take that?
Yeah, well, let me give an example, actually starting with the customers. Because some of you might actually following this conference through a piece of equipment on the backside, most likely, where our paint is actually located, i.e. a Dell computer. We basically were awarded by Dell Industries for our transfer of their entire product range from solvent-borne to waterborne. I think a better example I probably cannot give. Mm-hmm. And as far as the suppliers is concerned, yes, over the years, we already active in particularly working on the more bio-based raw materials. But I would say it's clear that this is still a starting point. And I do know that particularly also together with our CPO, we are now literally approaching our suppliers and particularly look into the decarbonization and the transfer to other energy sources. So that program is ongoing as we speak.
Thank you very much, Klaus. Moving again to the Zoom environment where we have our next guest. Hello, could you kindly state your name and company, please?
Yeah, thanks for having me, Christian Feitz, Kepler Cheuvreux. 2 questions, please. I think I'm asking this question at every single AkzoNobel event, but now that Michael Friedl is on board, I might try again, and we might get a different perspective. Why do you believe you don't need to be in the automotive OEM space, since you're a rather big refinish player? Any synergies there you could identify? Second question, on Deco. What happened in Brazil with you now being only a close number 2, as you labeled it, Terry? Your key competitor in this market is not exactly the prototype of a globally acting Deco company. So how do you plan to fight back in this biggest Latin American market? Thanks.
Yeah, all right. So let me take the Deco one, and then Michael, you can address it. Maybe there's a bit of a misunderstanding. The company who is the number 1 has been the number 1 there forever. We were a relatively distant number 2, then we were a closer number 2, and now we're a number 2 that for 4 months this year was actually selling the same amount as the number 1 in the market. So in fact, we're catching up. It's not falling behind. It's actually catching up. So that might be a bit of a misunderstanding. In Argentina,
I always thought you had 20% you and 20% the company starting with B.
No. Argentina is a different case. Argentina, we are by far the market leader there. Brazil, we've always been in a number 2 position, but the team there is very much swearing expensive oaths on taking over the lead position there, doing a pretty good job on it. So it's actually catching up. It's not a falling behind. Michael, on automotive.
Yeah. Hi, Christian. Thanks for the question. Yeah, indeed, we are supplying into the automotive OEM business as well. We are more in the plastic coatings there, so it's not like we don't have any automotive OEM business. We stayed away from the metal coatings. It is a very commoditized bulk type of activity. And at this point in time, we have no interest, even though technically we can probably produce a coating that would work on a car. It's not in our interest to enter that game.
Yeah. Christian, maybe one other thing on the vehicle refinish versus OEM. There is no synergy between the two. It's different products, it's different customers, and maybe on a long winter night you can try to do a correlation on who's supplying the which paint supplier is supplying the OEM paint and which one is supplying the aftermarket refinish paint to that same network, and there's no correlation whatsoever. So it's a different product, different channel, different distribution. Fair to say that we feel very comfortable in the distribution market there, because that is actually, given our Deco background, a very strong part of the DNA. In OEM, I think it's I can only 100% agree with what Michael has just said.
Okay, thanks.
Thank you very much for asking your question. Another question from Lucy from Bernstein, who asks, why don't you give an ROIC target, and how confident are you that growth investments won't overrun? What is a reasonable ROIC target by 2023?
Yep, thanks, Maarten.
Yeah, so let me first take a step back, because in Grow and Deliver there are a few elements we are very much focused on. That's, of course, one is growth. The other one is the realization of our EBITDA target, 2 billion EBITDA, and of course working capital translating in cash. On terms of ROI, I must say that there is an enormous discipline in the organization, not only on the M&A side, but also internally on the capital investment side. That's why there is less focus in terms of our external communication on ROI, as well as with our Grow and Deliver strategy, we will see incremental step-ups automatically from an ROI perspective.
Thank you very much, Maarten. Going back to Zoom, because we have our next guest waiting for us. Please state your name and company. And turn on, please. Hi there.
Sorry. Hi, it's Georgina from Goldman. Thank you for taking my question. It was really noticeable in your presentation that you were highlighting the strength of Akzo's brands. And I think it's fair to say that the brand that most investors are familiar with is Dulux. So there's this perception that Akzo's been over-earning from DIY trends during lockdowns. Can you remind us of your group exposure to DIY, and what gives you confidence that that's not going to be a major drag on volumes for the group over the next year or two?
Yeah, I gladly do so, Georgina. I think we covered that to some extent in our fourth quarter results, but the DIY exposure is in the revenue number is about half of the European part of Deco EMEA. So that would probably, I'm doing the calculation in the back of my mind, but you probably have to look at something between 700 and 900 million euros as the DIY exposure for the company. So it's relatively limited. I think there was a chart in our fourth quarter deck, which I think we tried to explain it, that the DIY was indeed in Europe up. Now, for some reason, everybody seems to have forgotten that the performance coatings was down in 2020. That seems to have been forgotten. Everybody focuses, oh my God, what's going to happen? Although we pointed out. But secondly, also in Europe, while DIY was up in some markets, the trade business, the professional business, was down significantly in all of the markets. Again, people were bored at home, started painting. At the same time, they didn't want to have a professional painter around the house. And in fact, as these things are balancing out, what we've seen now over now almost a year now, we've seen that the do-it-yourself in Europe is balancing out at about 4% higher than 2019. And by the way, that came down at the end of the first quarter last year to that level and has stayed there. But that the trade business is back and what it was before the pandemic, and that therefore we are pretty optimistic around the underlying market demand. But there is notable market share gains, and I talked about the UK as an example. I think, Georgina, you have probably some estimate in your mind around how big our market share in the UK is. But surprisingly so, we have clear evidence that we've gained market share. And by the way, the Heritage brand, which is the super premium brand targeting an already existing brand that we could not acquire because of our market share, is making very fast inroads into that segment. So we've, even in a market like the UK, we actually have been gaining market share. So in that sense, there's really no worry in our side around do-it-yourself is going to do something bizarre and it's going to be a big negative. That has already happened, and it actually hasn't been noticed by anybody because the other dynamics were making up for that.
Does that answer your question, Georgina? Thank you very much. You froze, but I think it satisfies your end. The answer was satisfying. We have our next guest on the Zoom. Could you please state your name and company?
Hi, good afternoon. It's Rob Hales, Morningstar. I had a couple questions on powder. I was just wondering, what's your market share now? My understanding is that the market's still very fragmented. And when did you start using powder on different substrates? And is this unique Akzo IP, or are your competitors also doing this now?
Michael?
Yeah, thank you for the question. So market shares first. So you saw us putting a clear number one position on that chart. I think it's fair to say that we are by far the clear number one globally. It depends a bit on the region you look at. I would say it's a fair assessment to look at the Asian market being a bit more fragmented than the rest of the world. So our market share outside of Asia is probably higher than within Asia. But even including Asia, we are by far the global number one in powder. Now, on the substrate question, we've been experimenting with different substrates for years, if not decades. So classically, of course, metal was the starting point there. And we've tried to open up, in fact, new substrates like wood or plastic, which just need lower baking temperature. Otherwise, you destroy the substrate while you bake the powder. And we have indeed had breakthrough innovation and IP to move into those segments now. And we have started doing that already 2 years ago with wood, and slightly before that already with certain plastic applications. But the growth is significant, and we have high hopes for opening up a totally new field for our powder business with that.
And there is technology protection on it.
There's IP, yeah, there's IP protection on the technologies there for low bake.
Does that satisfy your answer, your question?
Right.
Sorry. Yeah, thanks so much for joining.
Thank you very much.
Thank you. While we're with you, Michael, another question coming in from Laurent Favre, who says, it seems that the payback on the raisins investment is less than 3 years. Are there other areas where you would consider integration?
Bonjour, Laurent. Thank you for the question. Yeah, indeed, the payback is fairly quick. You've heard me say that this is not about us investing into new vessels, creating new sites. This is about using what we have in a smarter way with a fairly limited capex and some opex that we invest. And therefore, indeed, it is a fairly attractive turnaround for us here. We right now have no plans to build additional assets to increase our backward integration. I guess that's what the question is trying to get at. That's not the plan. We really are looking here at efficiency to a certain degree and security of supply with the assets that we have by managing them a bit more smartly and sweating the assets a bit more.
All right. Maybe let's take another question from Laurent while we're at it. He says, in the bridge, where would you assign the headwind from fixed cost inflation? Do you still assume separate productivity efforts can offset that?
Yeah, very good question from Laurent. So I think it's probably good for you, Barton, to sketch that. I think there was answers across the presentation. Yeah. Probably good to summarize it.
Yeah, I think that we go back to the presentation of Cara-Marie, and Cara-Marie has been talking about the productivity efforts, the continuous improvement initiatives, ALPS. And these, all these initiatives, and by the way, the productivity of 3%, these initiatives drive the offset against the fixed cost inflation. So indeed, in the deliver part, you see that fixed cost inflation is offset by the productivity efforts.
Just maybe one other additional comment on that is on the, because there is of course a wage bill pressure that's actually mounting. Also there, by the way, also for 2022, we do have the efforts in place to offset that to other means. So the whole idea is around the inflation offset remains core to our whole exercise. And that is going to be a bit more of a hump this year than it usually is, but we are determined to offset that too, yes.
Great. I know there's another Zoom question ready, but just to finish off, because I see Laurent had 3 questions, so let's just treat them all. He asks, when you look at slide 72, I hope you know what's on slide 72, what do you think the market is missing about Akzo, and why reduce the buyback envelope when your own stock is relatively more attractive?
I don't think well, first of all, what are the market missing? Well, I think you are the analyst, so you tell us what's been missing. It's a good question though, but I do believe it's a long overhang from the history of the company. We often have a huddle in our offices on some of the reactions that are happening or some announcements that some competitors make, which we believe we wouldn't necessarily be allowed to make without being laughed out of the building. So I think it's just an overhang. To be honest, 15 by 20 was seen as, yeah, right, that's never gonna happen. It did happen. I do believe that we make it as a core value for the company to stick to the promises, so we wouldn't make the promise if there isn't a plan behind it. If you then do the calculation, yes, it is a bit bizarre, the discrepancy between what the valuation is and where we are. But that's frankly, it's a good thing. As it resolves itself, that's fine. So we're not too worried about it. The second element around the buyback, Laurent, there is not really a reduction of the buyback. What we announced, and Maarten already alluded to that, is the modular share buybacks, where we want to do this. What we don't want to do is start announcing big buybacks and then all of a sudden in the middle say, oh, we were just kidding, we're going to do something else with our money, an M&A plan, etc. So I think what we've been explaining is that we want to have these tranches, which give certainty to the shareholders, but also doesn't tie us up completely for not having any freedom to work on any project that comes back. So it's just, we see that as good parenting for the company. So it's not exactly a reduction. You may remember that in the past we've done a number of slices, keep me honest here, on 500 million.
Correct.
And the last one was a 1 billion over a longer period of time, but that was more the exception than the rule, I would say.
Thank you very much. Sorry to keep you waiting, and thank you so much that you're here with your question in Zoom. Could you please state your name and company?
Yeah, hi, it's Jeff Hare from UBS. I just had a very quick question, actually. I think, Maarten, you're increasing your capex to sales guidance for the period to 3% from 2.5%. When I look back at a presentation in July, could you just explain what that's for?
Yeah, Chris, that is very much Jeff, sorry. That's very much to support our growth plans. And you saw that we are, on one hand, moving much more capex to growth initiatives, and on the other hand, also regionally drive more capex to the Asian region. And powder is a great example. We have a leading position in powder. We have very strong growth plans in powder, and that's why we put our money where our mouth is, and that is also the investments we are making there.
Yeah. Maybe if you allow me maybe to build on that a little bit, and Michael chime in here. When we did the analysis on the growth of the powder coatings market, it was clearly there. Then when we looked at how we were performing, in fact, it became clear in the analysis we did end of 2020, beginning of 2021, that we were often constraining ourselves. We were waiting until the assets were filled up to a certain percentage before doing the investment, and then we were too late with the investment. And that is, I think, what you explained, the cycle. And maybe you want to comment on that.
No, absolutely. And that's why we have come up with a multi-year, very dedicated investment program that is going to really create another step up in our ability to serve the market. We wish we would have been able to produce much more this year. We could have easily sold significantly more volumes, and that's why we have stepped up our game here.
Hope that answers your question. Thank you very much.
Thank you.
And moving straight to the next person. Oh, we've seen you before. Hi, you're back. The floor is yours.
Hi. Thank you. I have two questions, actually. First one, Thierry, just on pricing. So very well done on the lead that you have versus the Americans and the public companies and hopefully also the private companies. But at least for me and a lot of your peers, even like the lead that you have is a little bit almost unbelievable, really. So is there any surcharge element in this pricing element that you've pushed through there, where if raws do go down in the second half of 2022 into 2023, that AkzoNobel pricing will be actually on the other way around, even more volatile, or rather, if not volatile, it will go down more? Or do you think that actually you've done a phenomenal job, and whatever we see, the 12 to 14% pricing is real pricing? And then I have one follow-up question as well, which I'll ask afterwards.
No, Jaideep, a good question. I think but it goes back to the question we had from Laurent Favre: what is the market missing? So when we actually are outperforming clearly competitors who are asleep at the steering wheel, the question is, where's the catch? So frankly, we were ahead of the others, and that's full stop. So the surcharges are a minimum part. In fact, I can't even remember where we would have done it. So if it is a minor part that frankly is negligible. So there is no surcharge that was implemented that's going to go away when something else changes. What we have been saying is that in our distribution businesses, we will likely hold on to virtually all of that price, even when the raw materials start normalizing. There are some bigger industrial businesses where there are indexes that are related to raw materials. And there, in fact, every single time after 3 months, we had to eat the raw materials for 3 months before we get our prices up. Given the contract, that's going to work in our favor on the way down. But there are, of course, in the big industrial segments, we are also realistic that becomes then related to what your raw material market is doing. And hence, the statement that we believe in about 60+% of our portfolio, we see a significant margin expansion coming our way as we change our management model to actually hold on and keep expanding that margin.
And I think there was a second question.
Just thank you. And this is now, you're going to love this theory. So if Cleveland does wake up one day, when they do wake up, do you now see that you are sort of at par with Cleveland, i.e. you are sort of best in class, or going towards the reference, as you sort of said, and therefore Cleveland will have to put what they are trading at on the table for you to talk? Or are you never going to talk and keep buying your stock?
Well, okay, so things are going to happen as they happen, I would say. So that's, and if there is anybody knocking on the door, we have our fiduciary responsibility to look at that, obviously. But I'm also not a big believer in remaining so ugly that nobody ever wants to talk to you. So that's not a good business model either. That is actually the furthest of our mind. I think it's not around who is stronger than who. I think for us, the only thing that drives us is actually having a portfolio of businesses that is delivering with the best, is growing with the best. Again, 15 by 20 is not around growing, and then creating a valuation for a company that it deserves. And then, Jaideep, the rest is actually just speculation on who might be talking to whom about what, but that's really not on our mind. It's not a fear point, but it's not on our mind either at all.
Thanks a lot.
Thank you. Back to the platform with a question from Tony Jones. For the resins opportunity on slide 51, why is the target for utilization only 75%, which internalizing supply is an EBITDA gain?
Michael, you want to take that one?
Oh, absolutely. So clearly you saw that all of our slides were geared towards 2023. And it's fair to say that we will probably not stop at the 75% in 2023. And that there's more room to move forward with internalizing parts of the resins. We will take that decision when it comes in 2023, but the step up from 60 to 75, that's already a logistical challenge, and it doesn't happen overnight. So it's a quite ambitious target to get to 75, but we're quite committed to get there. We will probably not stop there.
That sounds firm and a good answer. We have another question coming in from Eric, if I see correctly, Eric Wilmer from ABN AMRO. On the migration to OneERP system, how many savings would you expect from this step, and how much are the associated costs? And by when do you expect completion?
Maarten?
Yeah, I think it's important to realize that the ultimate migration to OneERP is really beyond 2023. So the steps we are now making is to further consolidate our landscape, and ultimately the OneERP solution is beyond 23. That will give additional investments to do that, but also will give again additional benefits, especially from a transactional processing perspective and additional transparency perspective. But I think it's a little bit too far away to go here into details, because we have made already major steps given where we came from. I don't know if you remember, we came from more than 40 different ERP systems in 2018, and now we are in a much better state compared to where we were before. So step by step, we execute on this roadmap.
Thank you. Moving to our next guest in Zoom. Hi there. Could you state your name and company?
Yeah, hi, it's Martin Evans, HSBC. Following on actually from Martin there on the ERP and such like, on your deliver target, the 200 million, a lot of the themes are pretty familiar. Raw material standardization, planning optimization, reduced complexity, both, I guess, from you with various restructurings at Akzo and also from other manufacturers. What is new here that hasn't been tried before? Because is there not a finite level of cost savings and efficiencies that you can extract from this business? Thanks.
Well, yeah, I would say it's always finite, I would say, but the ERP and the product management, the ERP gives us the data transparency, because first of all, you have to see where the issues are. The product management gives us the methodology that we didn't have to really then start acting on that. So you could theoretically say, is it finite? I would say theoretically, yes, when you have it full optimized, but to be honest, we can keep ourselves gainfully employed for the next foreseeable future to keep optimizing that. To be honest, Cameron, it may be good, and it's maybe not good to go into the gory details, but are you afraid you're going to run out of opportunities in the next couple of years?
No, I would put it like this. I joined 5 months ago, have really now rolled up the sleeves. There's lots of opportunities, as you have already heard me allude to. There's a number of also areas that we have not really been looking into, but I think one of the clear prerequisites from exactly improving, utilizing, running the asset even harder than what we've done currently is really dealing with some of the complexity. Needless also to say that end-to-end planning optimization will give us much, let's say, different ways of discussing and also working with scenario planning. And then also, let's say, embarking on the digital journey. That is for sure also one of the ways to go as we go forward, and utilizing the global network that we have, no doubt.
Harry, when you joined 4 years ago or so, was it obvious to you then, when you had a look at the business, that there was all this opportunity that you're now focusing, or have you had an epiphany during the COVID period that has opened up all these amazing new opportunities for you in terms of reducing cost and efficiency?
Yeah, no, despite the rumors, I've not taken up smoking marijuana in Amsterdam, if that's the question on that. But no, in fact, here's the story. When starting this, my first reaction was to start putting product management in, because it stares you at the face on how this product portfolio, the complexity, what a kind of a giant heap of opportunities that was in front of us. Back then, and Martin is my witness on that, I stopped from pushing that because it was clear we didn't have the systems and the transparency to do so. Just want to remind, we had no integrated business planning in place. So frankly, we were a little bit like the butcher around the corner. When somebody walks in for steak, they cut a steak. But that's not something that you can keep doing. That is actually working very well. I may point out that in 2021, despite everything that happened, our planning was actually pretty accurate despite all the turbulence. So I think we got to a certain level of maturity in our planning. We didn't have the systems. We didn't have the master data, the systems. So first you have to know, what does it cost? What is the complexity of it, etc. And in many cases, we didn't even have the transparency 4 or 5 years ago to figure out who buys what raw material from whom at what price. That was kind of the situation. So then I folded my product management idea back in my pocket, because it was a waste of time to try to do it. And therefore, when we were at the end of 19, and in fact in 2020, beginning of 2020, We identified the people who could do product management. We actually attracted a number of top product management profiles from the outside. And in fact, in 2020, we started working, and then through 2021 doing the work. So the plan was always there. It just takes a lot of viscosity to get to it. And I just want to point out, and in fact, that's a compliment to Maarten here, I would say the founders' work in just getting structure and having a system and having transparency that now allows us to build on that. And I think, Karen-Marie, in your role, it actually helps a lot to understand what is the productivity, what is the profitability of a site, etc. And believe it or not, it took us a couple of years to get that transparency to the table.
Thank you, Thierry. Does that answer your question? Yes, I think that's a yes. I will take it for a yes. Thank you. I'm moving back to the platform because there's actually 3 more questions from Chetan Udeshi, and I thought let's just do all 3 of them at the same time. Will there be a premium for a low carbon raw material?
The answer is a very clear no, unless we can make more margin on it. So I give an example. I am a big believer, and I'm happy that my management team is a big believer also in sustainability should not be a boundary condition on your business. It has to be the way how you drive your business forward. I think, Klaas, you've been instrumental in your CTO role to not make that a trade-off that you have to make in the business. So just because it's low carbon, paying more, that is not a good business model, and that is not sustainable for the company. Mm-hmm. There is one big difference, though, if our customers are willing to pay more for it. And there are examples of that. I mentioned that some of our deco paint, for example, in China, when there is it's less around low carbon, but it's more bio-based materials, where the consumer is willing to pay considerably more for that product, that's what we have to do. I think we really have to see sustainability as how it strengthens the business and not a self-created headwind. And I also, honestly, I see no reason for doing that. So our suppliers who go to low carbon through renewable energy do not have to make the trade-off necessarily on them costing more, etc. So that is a clear boundary we have set ourselves.
Very clear.
We want to stick to.
Very clear. Which are the key resins that Akzo produces the most? Yeah, I think that's the question. Acrylic, pure, VAE, etc. And which resins is Akzo expanding the capacity?
Yep. Michael is a self-declared king of resins.
King of resins.
Let's not have that stick. But yeah, we have the capability to master many of the technologies that have been mentioned in the question here. We have 23 sites where we already produce resins, all kinds of different resins. When it's about what we plan to insource a bit more or work with our supply partners to optimize networks more, it is much more towards the, I would say, bulk resins rather than the specialty resins.
Thank you very much. And there's one more on resins, if you don't mind. Is resin supply the key issue or the upstream resins raw material supply? And how does expanding internal resins capacity help solve the upstream supply issue?
Yeah, clearly the biggest pain point that we have had was with the resin supply. It depends a bit on which upstream material you talk about. So clearly there have been also shortages for some of the upstream materials that are needed to produce resins. But the bigger bottleneck clearly was and still to a certain degree is with the resins. And therefore we have high hopes to improve the bottom line here also by solving some of our sourcing issues.
Thank you very much. I'm just going to check in with the director to see if there's any more Zoom questions. There's no more Zoom questions. We're going to wrap up this session. I think you were amazing. A full hour of answering questions. Very well done. I would like to thank all of you, Michael, Karen-Marie, Thierry, Klaas, and Maarten for being here. And I would like to thank you at home for being with us or in your office for being a part of today's session. We hope that all the information shared here today will leave you as confident as everyone here on the Grow and Deliver strategy. As I said in the beginning, the presentation and the playback will be made available via the website AkzoNobel.com. For my part, and I'm sure on behalf of everyone here, thank you again for watching. Enjoy your evening or enjoy your afternoon. Bye-bye.